right, well, welcome to the February edition of the Beyond Wealth Advisors Economic Update. I'm John Cleaver, partner and senior financial advisor, and I'm honored today to have JC Ganote,
Thank you, John.
good friend, longtime advisor, and just a true professional in our industry, and does an awesome job of serving his clients. And we're going to have fun chatting today. So thanks for joining.
Thank you, John. It's great to be here. It's actually a privilege for me to be here and be able to chat with you today about what's going on in the economy and just kind of how it affects our clients and the decisions that we make for everybody. So thanks for having me. Appreciate it.
Absolutely. I mean, I know you're at one end of the office and I'm at the other. We see each other almost every day, and probably have a conversation, but this is special. So thanks for being here. So
absolutely.
This month, we're going to be talking a little bit about how the U.S. consumer continues to just defy expectations. And of course, probably the biggest topic is the Federal Reserve not cutting interest rates in January. So let's just jump right in. If we think back to last month when Grant was here and we had a chance to kind of look back on 2023, we now have some data.
Right.
And what we know is that the U.S. economy continues to remain strong. December was a fantastic month. And honestly, for the year, we ended up about 2.5% up on GDP, which I'm not sure anybody expected that.
Very strong quarter.
Back. And a lot of that is driven by the resilience of the U.S. consumer. While maybe not completely surprised, maybe they exceeded expectations somewhat. As spending just continues to grow, really. So as we transition then into some of those economic particular areas that are driving that, let's just jump right in. So inflation continues to be a topic. We hear about that almost every day. So, JC, why don't you kind of give maybe a high-level perspective, from your seat, kind of what you see going on with inflation?
Well, inflation, in respect to the way the Fed measures it, it stayed stubbornly high for some time now. And when it really topped out at the highest point, inflation had an annual average run rate of about 9.3%, a little over a year ago.
Right.
But steadily since then, with the Fed raising interest rates at the pace that they had, it's had an effect on that trend, and that trend has now come down quite a bit from that average run rate of 9.3 down to about 3.5 right now.
Right.
And so the Fed still has a target of a 2% minimum on inflation, but that last 1.5% may take a little bit longer to get that back out of the economy than the first several percentage points coming backwards did from what they did with interest rates.
Yeah.
So it's gonna be high. It's gonna remain stubborn for a while.
Yeah, that makes sense. So that's a good segue into interest rates. So they kept interest rates the same for January at the January meeting. How does that tie into kind of what you see going on with inflation right now and kind of getting down to that target and kind of how those two are intersecting right now?
Yeah, there's a really delicate balance that the Fed has right now in front of them, and that is to make sure inflation doesn't come back. Even though the economy is strong, that balancing act of a mild recession or a soft landing we've heard in the past is kind of what they're aiming for, and it looks like what we're kind of coming into. But they got to be really careful how quick they do cut interest rates, because if they cut interest rates too quick, inflation could rear its head again.
Right.
And at the same time, the Fed does not want to have to go back and raise interest rates down the road because they cut too quick.
Right.
So they've got an interesting balancing act to do. I think they can pull it off. But as the data comes in, and they're more data dependent month by month, as they see it unfolding, that will help their decision making. But eventually we are going to get to a place where interest rates do start coming down.
Yeah, that certainly makes a lot of sense. So some of that data, I mean, we certainly continue to see a strong labor market, right? Unemployment's continued to stay relatively low. Productivity continues to increase, right? So which is typically good for the bottom line of companies. So as long as those things are happening, is there any real reason for them to continue to drive rates down kind of unnecessarily?
I would think not, simply because they've engineered it so far to the point where we're at that things are going pretty well. So why would you necessarily jump the gun with everything you've done over the last, say, 24 months to get us where we're at right now, to potentially have that come unwound,
Sure.
And so inflation, we haven't really dealt with inflation at the level we're dealing with it right now. So it's not something that we exactly know how to deal with.
Right.
Like coming in and out of recessions, we've done
Sure.
that many times over the years. But inflation's a different animal,
Yeah.
and we're fortunate this time around with the inflation we've
Mhm.
had that we've had low unemployment while you've got high inflation.
Mhm.
Because if you had high unemployment while you have high inflation, now you've got a real problem on your
Yeah.
hands because you got people out of work with no money to spend
Right.
with higher prices. We haven't had that this
Yeah.
time around, and that's made a big difference, I think, on
Sure.
how we've came through this.
Well, let's transition just a little bit. We've been doing these updates for a while now, and Dennis and I in the past have always talked about kind of the difference between what's happening in the economy, both domestically and globally, and then also what's happening in the markets, right? So we've talked a little bit about more kind of the economic side of things, more of what's going on with some of those key things like inflation and interest rate. But let's kind of transition a little bit, maybe talk a little bit about just kind of the markets in a sense. So, we've seen a lot of positives, right? I mean, obviously things recovered really well at the end of the fourth quarter, and although the start to the year has been maybe a little bit mild compared to that, we've still seen both global equities and U.S. equities have, consecutive positive months, and certainly showing signs of inching higher. Maybe just talk a little bit about kind of from a market perspective, kind of what you see happening right now.
There's a lot of people that have missed out on some of this rally that's occurred in the last number of months. There's a lot of money on the sidelines, and we're beginning to see in the markets continual effect of a broadening out.
Right. What do you mean by that, broadening out?
Yeah, we typically what we had seen last year, a lot of what led the market was 7 to 10 stocks, let's call it, and primarily in the technology space.
Right.
But now, as people are beginning to realize that we're closer to the end than we are the beginning,
sure,
with all this whole cycle of interest rates and unemployment and this and that people don't want to miss out. And so there's been a lot of money move into equities, and we're beginning to see that broaden out into mid-cap stocks, into small-cap stocks, in the different indices like the Russell 2000. Other stocks are getting money flowing into them now, because people are beginning to believe, they're finally beginning to believe that we are going to come out of this okay, and they're willing to commit money, especially in the face of interest rates coming down. That typically bodes better for small and medium-cap stocks, where their borrowing costs go lower, and so the profit margins go higher. And those stocks find money. So
you mentioned small cap. So there's definitely been an imbalance between large cap and small cap. In fact, I think since about a year ago, just not quite a year ago, almost the widest margin we've seen between large cap and small cap, which generally means something's probably good about to happen, right?
Yes, exactly.
So when you think about the positives that are coming ahead, what does that specifically mean for those small and mid-sized, companies, and why you want to be more broad in terms of your diversification and maybe your kind of overall allocation as you look at things?
You're speaking to it right there when you say about being diversified, because that's the one main key thing that we as advisors know, that if our clients are well diversified and not just sector specific like in technology only, as interest rates come down, profit margins go higher. And because of that, stocks have to go higher. That's typically the way that it works.
Sure.
And so these stocks are going to continue to find investment dollars as interest rates come down, because it makes those smaller and mid-cap companies more profitable. And so we're beginning to see money flow into that space. And we'll probably continue to see that for some time to come, especially when rates actually do begin to move down.
Yeah. Well, let's not leave out fixed income, maybe real quick. The bond markets and even the U.S. dollar and all of those kinds of things. So obviously bonds had a tough go. 18 months, 2 years ago. 2022. We don't
2022 was a bad year in the bond market.
Let's not talk about that. But I think the prospects are even higher for the bond market right now.
I would agree with that, John. I think that typically we see an inverse between stocks and bonds. We didn't necessarily see that in 2022, but I think we're going to go back to that. We're going to go back to typically seeing bonds operate the way we know they've operated in the past. Because when interest rates come down, there's going to be a higher premium placed on bonds that were issued at higher rates previous to that. And so that has to work that way.
Right.
And so, there's going to be a bid, I believe, in the bond market for some time to come, because they're not going to be able to lower interest rates that quickly.
Right.
It's going to take
it's going to take longer than the rate that they went up.
Exactly.
Yeah.
And because of that, there's going to be a decent attraction to the bond market for fixed income for lots of clients.
Yeah, so that really speaks to, again, just not only diversification across big, medium, and small, but also across equities and fixed income and potentially even international, just that well-balanced approach. So, well, fantastic. Well, that's a lot of ground that we covered in a short amount of time, and certainly appreciate
Thank you
your
for the
wisdom and coming
it.
and being a part of this. I know you'll be back for future episodes.
Not going anywhere.
You're not going anywhere, no. So with that, we're going to wrap up the February economic update. And on behalf of JC and I, we thank you for listening in. And, as we kind of transition into the year here, as we always do, it's just such a great time just to stay connected. The markets change, the economy changes. There's a lot happening in 2024.
A lot to sort out.
A lot to sort out, yeah. So we're here to help. Don't hesitate to reach out. And we look forward to the next time we get to connect. Have a great day.
Thanks, John.
Yeah.